Hello, I'm joined today by Bill Ackman from Pershing Square Holdings. This FTSE 100 investment company holds large stakes in a select number of well-known companies, including Universal Music Group, Hilton and Lowe's. Bill, thank you very much for joining us.
You're welcome. Thank you.
So Bill, it's been a pretty difficult year for all investors really. Are you frustrated about the performance of Pershing Square Holdings? And if so, what do you think will be the catalyst to improve performance?
Sure. So I would say I actually feel quite good about the underlying performance of Pershing Square Holdings. We're generally a levered long only investor. I mean, Pershing Square Holdings has about 20% debt to total assets, long-term unsecured bonds without covenants, and we own stocks. And in a world where the S&P is down 17%, the Nasdaq's down 30%, being down 11%, actually strong relative outperformance. And I can explain some of that. I would say the only frustration I have is really the discount to NAV, which has widened. And actually, it seems like the better our relative outperformance, the wider the discount gets. I mean, the last 4 or 5 years, we've vastly outperformed, every one of our benchmarks. NAV's up, from below 14 in early 2018 to today over 50. That normally you'd be quite excited about those results. But the share price returns have not been as strong because the discount has widened from something in the 15% range to the 35% range over time. So it seems that the better we do, the larger the enterprise, the bigger the discount. So if I have any frustration, it's that.
I mean, you've got a reputation for using complicated financial instruments to add a sort of protection to your portfolio. Have you been sort of buying more of that, given that we've had a pretty difficult time this year?
So we've actually made a lot of money on our hedges. So we spend a small amount of capital on investments that have option-like payoffs, and many of them are actually options themselves. Not inherently particularly complicated, but a bet on interest rates rising, for example. So a couple of those bets have led to large profits for us this year. We've invested a little under $400 million, and that's turned into about $2.8 billion system-wide. Some of that profit was unrealized last year, accrued into our results last year, and the bulk of it has been realized this year. And those have been some very successful hedges, and we're doing more of that. It's something we've done over a long period of time, opportunistically, and I would say inherent volatility, uncertainty of the world has made a number of those hedges both good hedges and also interesting standalone investments. So anytime you can hedge the portfolio, so for example, we thought rates would rise a lot, and we hedged rates by buying so-called interest rate swaptions. It helped offset some of the mark-to-market losses we've suffered on the long side of the portfolio, but it's also, on a standalone basis, a good investment, and those are the best hedges, ones where you don't mind making a big profit on the hedge, even if your stocks go down, because we think the businesses we own will do fine and recover over time. And in fact, our companies have actually reported quite good results, and so what we've seen is more a reduction in the multiples people are paying for businesses, really no real impact on the underlying companies themselves, at least for our portfolio.
I mean, do you think that the fact there are some investors who don't quite understand the things like swaps and the financial engineering you do in the portfolio, do you think that is a reason behind the double-digit discount to net asset value at all?
I don't think so. I think if anything, people like the fact that we're not just long-only equities in a challenging market environment. They like the fact that we're able to hedge COVID risk in 2020 and turn it into we were up over 70% in 2020, driven by a very successful hedging strategy. I mean, I think the good news here is the people making the investment decisions have enormous skin in the game. So myself and other employees own 26% of the closed-end fund ourselves, and we didn't get that through an option program. We got that by purchasing shares in the open market, and that gives us a lot of skin in the game. So it's not you should worry if a manager has no skin in the game and they're doing all kinds of speculative stuff. We don't do lots of speculative stuff, and we have a lot of skin in the game. What we do is we invest a small percentage of our assets in instruments that have asymmetric payoffs. So if our interest rate assessment didn't take place, we would have lost $180 million, let's say, on our first hedge, which in the context of a $12 billion of assets is a relatively small sum. But if it pays off, you will notice. And so we like investments like that also offer a hedging benefit. A world in which rates did not rise is probably a world in which our stocks would have done very, very well. So it has the benefit of cushioning the downside. I think the discount is largely driven by the relatively small universe of people relative to kind of general investors in the market that buy closed-end funds. Mm-hmm. And as we're the second largest closed-end fund in the world by NAV, and the universe of people who can own us, therefore, and we also outperformed dramatically in the last 5 years, and so we've outgrown, in some sense, the traditional buyers of closed-end funds.
Do you think that would lead to listing the Pershing Square Holdings in the US then, for example?
We'd love to list in the US. We're on the London Stock Exchange because under the current US regulatory regime, we can't list Pershing Square Holdings in the US. Our business would have to dramatically change in order for that to change. But it's still something that I made allusion to this in our semi-annual report. If we were to end up as a controlling shareholder of more than a substantial majority of the companies we own, not just a large minority investor, but a so-called controlling shareholder, then there's more flexibility for us to move to the US. But that's not an overnight phenomenon.